Happy Monday, everybody. I hope you had a great weekend. Today is October 11th, 2021. In addition to it being Columbus Day, this is your Monday market update video. No market closure for Columbus Day this year. So, by the way, that's how the video was supposed to start yesterday. I apologize. I was traveling to South Carolina yesterday and planned to do the video as soon as I landed, but due to a slight delay in the flights, and then I was in meetings literally from the time I landed until I didn't get the chance to look up until 6 or 7 o'clock. And as great as my marketing guys are, they weren't able to put that together. They would no way would have been able to put that together to get it to you yesterday. So here we go today. So happy Tuesday. Today is October 12, 2021. This is your market update video, and the good news is you get an extra day of data in there. So here we go. Let's dig in. Once again, last week was full of action. Let's review what happened last week and let's see what we'll be watching this week. Last Monday, October 4th to be exact, to be clear, started with a bang, or what I should say really was a thud, as Facebook news from the 60-minute whistleblower interview and rising treasury yields, to name a few reasons, led the market, which actually opened with an attempt to follow through with the upside from Friday, but it fell flat quickly, moved lower quickly into the 11:30 hour where it set new lows for the day. Not much additional news during the day, and although the Dow did bounce off its down 500 level, it did close down 300. S&P 500 closed off the low as well, but still down 1.3%. NASDAQ was pretty ugly at the close, down over 2% for the day. Tuesday continued the yo-yo ride that we've been seeing a lot these days lately, right? So markets gapped higher at the open thanks to better economic data from overseas, as well as strong ISM services. There was good news for the U.S. economic growth. So overall, there was negative news flow out of China. China company news came out, as well as the IMF lowered, the global growth forecast. The market pretty much ignored that and actually closed up a little bit over 1% for the day. Wednesday saw the market headed down again yo-yo style, until news from Washington talked about the debt limit deal was close. The European inflation and stagflation concerns were not able to keep the market down. The S&P 500 was up about 0.5% for the day. Thursday, we saw more upside in the market as the market reacted again to the debt deal, the debt ceiling deal. So we also had some good news on weekly jobless claims before the open. The rally did lose some steam as the day came to a close, and the markets did some positioning for the Friday jobs number. The S&P 500 closed up 0.83%, but well off the highest points for the day. So the jobs number came in on Friday before the open with a thud, as the number badly missed the estimates. We'll talk about that in a minute. But we're seeing, but as we've seen a lot these days, the numbers are going to be, they were evaluated 100 different ways until they found a way that actually made it look good. So I'll get into that a little bit deeper in a minute. But regardless, as the numbers were crunched, the market drifted sideways most of the day. The S&P 500 closed down slightly near the lows of the day, but not a lot of major moves in response. So overall, the week was a positive week, about 0.75% higher on the S&P. And so just do a quick addition for Monday, October 11th, yesterday. The bond market and the banks were closed due to Columbus Day holiday, but stocks were open for business worldwide and here in the U.S. And stocks did just waver between positive gains and losses all day. Without any major conviction or data to provide a catalyst, the S&P 500 was down just over 0.5% for the day. Just a quick review. Let's go back to last week. A quick review of last Friday's big number that everyone was waiting for, the jobs number that we spoke about. It missed estimates badly, as I said. They came in less than 200,000 new jobs versus an estimate of close to 500,000 new jobs. So as I mentioned, they reviewed this thing all different directions, and they came up with a way that made it sound much better. Time will tell, but over the past few months, what they basically said was that we're averaging 500,000 new jobs a month. Now that is because of the fact that a couple of months ago we had a 1 million job print, and so averages, we know how averages work, so that's still showing that. But I will tell you that the numbers have gone down every month since then. So is it a trend? I don't know, but that looks like a trend to me. We'll just have to see what it looks like. The market is not saying that. The market is evaluating it as still a positive. So other data in the report where they looked in and they saw what it looked like, the private sector added close to 400,000 new jobs. Government sector lost about 130,000 jobs, mostly in local and state education jobs. They attributed that to seasonal issues as well as COVID. But overall, it wasn't a blowout good number. It wasn't a blowout bad number. So the market is looking at as relatively in the middle of the road. No big deal. So what are we going to be watching this coming week? Well, I thought we had a lot of Fed governors and presidents speak a couple of weeks ago. Remember we talked about that. I didn't know there were this many governors out there, that these guys, there's a lot of them speaking this week. Many of them are not voting members, but what we've seen, I've spoken about this before, is that a lot of these guys, they go out and they talk about what they think might happen or what the Fed should do. And the idea really is just to float out and see what the market's going to think. Because once the market gets an idea, the Fed can now evaluate, okay, this is how the market's going to react, so either I act or don't act in that way. So at least they have a better idea of what's going on. So speaking of acting, the Fed minutes from last month's meeting are going to be released on Wednesday. That's tomorrow. And again, if that information is anything different than what we're expecting from the tapering plan, which is later this year into early next year and about $15 billion a month coming back, then if it's different than that, then we're going to see, obviously, that will be the catalyst for the next move in the market, and it's probably not going to be on the upside. So Wednesday, we're also going to get the big CPI number. Remember, that's the inflation measure. With another Fed meeting coming up soon, that's going to be something they continue to watch. All of that, and again, that's not even the main focus this week. This week is not even Washington, right? Because they've kicked the can down the road till December, so we're really not going to see anything from them major for a while. This week is earnings. Earnings get started. I've mentioned this before, so let's buckle up. This week is mostly banks and others like that. And although we won't hear from much from them about supply chain and margin pressures, it has been interesting to get a read from banks on what the U.S. consumer is doing. They always seem to have that. They know that because of the cash in the bank. They know that because of the credit cards. But we'll see what comes of that and see what kind of information we get from that. Consumer companies start next week, and that obviously is going to see what happens. We're going to see what added costs and delayed orders look like and what that really makes the difference with those companies. What they think the rest of the year is going to look like. Listen for words like input prices, rising dollar, supply chain issues, and maybe even what the Fed actions are going to have effects on them. So we'll see what that goes. So as usual, we need to watch the 10-year yield. The yield was up big last week. Remember, the bond markets were closed yesterday. But the rest of the week, we got to watch to see. Remember, last time we were watching the 10-year, it's about the pace of the move. It's not about the move itself. So there's a lot of people who believe that we're going to make our way up to 2%, but it's just how fast we do that, and that's really the key to that. So as we head into another interesting week, we'll have a full week of the Fed and earnings, cap off the week with jobs information on Thursday. As always, we're going to get, the job numbers on Thursday, which is that high-frequency stuff, and then we've got the retail sales numbers on Friday. That's going to be a big deal to see how that goes. So as I say, there's always a lot going on these days. We're heading into the most important time left in this year. This earnings season is going to be full of information that's going to move markets. So as we've been talking about, it's time to stay nimble, use the moves in this market to rebalance your portfolio to make sure that the allocation is where we need to be. Earnings in the Fed are going to determine what the rest of this year looks like, so let's talk about it. As always, please watch for the Friday video back in Chicago and focused on more of the planning ideas for you. Have a great week. Please come back on Friday. We can put some more emphasis on the focus that we have for your goals and doing all we can to reach them. See you on Friday.